Welcome to Inside Economics. I'm Mark Zandi, the chief economist of Moody's Analytics, and I'm joined by my two trusty co-hosts, Chris Dorides and Marissa Di Natale. Hi, guys.
Hi, Mark.
Good morning.
Good morning. And you're back, Marissa?
I am. I'm back.
You're back. I mean, are you really back?
For the foreseeable future, I'm back.
The
Yeah,
foreseeable future. Well, and you are a forecaster, so you must
that's
be
right.
be able to foresee a
I'm
lot.
confident in that forecast
Yeah.
that I'm back. Yep.
Yeah. And it's good travels. See much of the
Yeah, I
world.
had a
Yeah.
great
Yeah.
lots of saw much of this country. It was really nice. Went to the Pacific Northwest for a week and a half, and then this past time I was gone, I was in New England doing a kind of New England tour, just visiting friends and family.
Very
It was very
cool.
nice.
Very
Yeah.
cool. That sounds like a nice trip. And we have got Matt Colyar. Matt, hey, Matt. This is CPI week, PPI week, inflation week, and you always join us on this week. Good to see you.
Good to see you, Mark, Chris, Marissa.
Have you
Hey, Matt.
taken your summer vacation yet, Matt? Or are you back?
No vacations here. I know I'm going to Marissa. Where did you
I
go
like the
in New
sound of
England?
that. No
Yeah.
vacation. Marissa, did you hear that? No vacation.
I did.
Yeah.
Yeah.
No, where in New England were you? We're headed to Rhode Island today.
I was in Connecticut, Massachusetts, and Maine.
Well, Scott, good to have you. And we've hit the big time, guys. We're on a new platform, Riverside. I mean, like the rest of the world was here a long time ago. We finally caught up. Not early adopters. We'll see how this goes. So far, so good. Except Marissa. Marissa's
I don't love it
you
so
don't
far,
love it so
but
far. Yeah.
we're 5 minutes into it. I'll get used to it.
And maybe can get Riverside senior management, to kind of help us out here. Yeah, that would be nice. Okay.
I don't know if that's necessary.
Not yet, at least. You don't want Zandy complaining about your platform, that's for sure. Yeah.
Yeah.
That would be the worst.
Absolutely not.
Absolutely not. Well, we've got a lot going on this week on the economic data front, so we're going to cover that CPI, consumer prices, producer prices, inflation writ large, and that obviously has been top of mind. And got Matt here to help us out with that, and we'll get to that in just a minute. Talk a little bit about we got retail sales this morning. The consumer is key, obviously, to the economic outlook, and can talk a little bit about that. But I think the headline here is the listener questions. We posed on LinkedIn. We asked everyone to send any questions, and we got a boatload. And Mercy, you've been collecting a lot even before the LinkedIn query, so we've got a bunch of listener questions. I haven't heard any of them yet, but we'll go through those. We'll play the game, and that'll be Good Friday kind of podcast, right? I think that'll be enough. Yeah, and
That's good.
I always threaten it's going to be short, but it never is. It's always an hour and 10 minutes. It's a kind of a law of podcast physics. I'm not sure, what that's all about, but we'll see how this goes. Okay, so I just dive right in. Yeah,
Let's do it.
Let's do it. Okay. All right, Matt. Inflation, CPI, PPI. What'd you get? What'd you read? And how do you read it all? And what does it all mean?
It's a great way to set the context. So consumer price index we got on Tuesday. Unsurprising report. Forecasts were all, including ours, pretty precise about what prices actually looked like.
You mean we
prices.
were accurate, is what you're saying?
We were accurate. Yeah, I would say this was unusually accurate. I go through components, and this is a good week or good month to pat ourselves on the back. So maybe it's a little bit of predictability, maybe it's a bit of luck, but either way, it came in as expected. 0.2% increase in the consumer price index. That's a little bit slower than the month before, but the year-over-year rate didn't change at 2.7%. That's unrounded. You look at that a little bit more closely. That's the highest we've had since January. So certainly part of this backtracking of the disinflation that we had seen previously, certainly going on. Within that 0.2% increase in the headline CPI, of course, that includes food and energy. And energy is a pretty big drag in July, so that shaved off some of the month-to-month change in headline inflation. Food prices were generally flat, although we can look a little bit more closely at that when it comes to the producer price index, but we'll table that. So excluding those two negligible and negative components, food and energy, we look at core CPI, and I think that was where, even if it came in as expected, it's consistent with this story that price pressures are bubbling up or are starting to pick up steam, and it's all relatively clearly downstream of tariffs. So we got a 0.3% rise in core CPI. Strongest monthly pace since January. The year-over-year rate jumped from 2.9% to 3.1%. Across the board, you're looking at components.
Can I ask this really quickly before you kind of go even deeper? So the number came in, the CPI number came in, as you say, where we expected. And I think we were consensus, right? I mean, I think the consensus was there. So we can pat ourselves on the back, but collectively, everyone got it roughly right. But the markets, the stock market in particular, took off on the number, suggesting, oh, they felt like the CPI number, the acceleration that we're observing is no big deal, nothing to worry about. It certainly won't be enough to forestall a rate cut by the Federal Reserve when they meet again in September. Were you surprised? I was a little surprised by that kind of reaction. Were you surprised, Matt?
I was. And that's exactly how I'd frame it. Unsurprising was kind of taken as synonymous with good news, even though the surprise or the prediction everybody had, the forecast is inflation is going to accelerate. And whether that's consistent with the Fed's view, and that means that the September of 25 basis point cut in September is more likely now. I think that's a reasonable argument, but hard for me to square what is a strong monthly growth in core inflation with good news that maybe the tariffs aren't biting or that businesses are handling this really well. I don't think there's evidence of that. I just think there was evidence that we knew what was coming, and that's kind of what manifests.
Chris, were you surprised by the market reaction to that number?
I was surprised, but it seems like the market is in the mode of any news is a reason to go up.
Right. Just a reason to buy.
Either you're going to get a Fed cut and that'll juice things, or it's not a problem and profit margins are going to be fine.
Okay. So if what you're saying is the market feels like it's getting a little overdone. It's taking on a life of its own.
Sure feels
independent
that way.
of pretty much everything except that prices are going up. Therefore, they will go up because people will speculate effectively. Yeah. Okay. We'll come back to that. Okay. So I stopped you. You were going to go into a little bit more detail, I think, on the CPI.
Yeah. So within core CPI components, the big guys that we focus on, shelter inflation, not too much headlines there. It's been a pretty consistent story of this owner's equivalent rent, tenants rent, all those prices are rising, but rising at a slower and slower clip, year-over-year growth coming down. Kind of, it's kind of anachronistic to think about where we were a year ago and saying, as long as that happened, we would get inflation down to where it should be. Well, it is happening, but there's, of course, these cross currents when it comes to goods prices and goods inflation. That's been in isolation, good story. Year-over-year growth in shelter continues to, trend lower and lower.
Which, by the way, if we go back a year or two ago, we were hand wringing. When are we going to see the impact of the weak rents, the flat rents, show up in the CPI for housing? And here it is. It's here clearly. It feels like the CPI is finally caught up to what happened to rent, has been going on with rents for the past 3 years.
Right.
Yeah.
Like if you just look at the past 3 months annualized, like a 3-month annualized moving average, shelter's rising at like 2.7%, which is exactly, that's what we're pining for all of 2024 and even 2023.
By the way, there's a lesson in that, for the current period. And that is, we all knew, or we felt like we knew with a high level of confidence that the consumer price index would ultimately reflect this weakening rents. The owner's equivalent rent, the rent of shelter would moderate. It just, because of construction and lags, it just takes time for that to filter through. But we were consistently in the public conversation was consistently saying, where is it? Why isn't it slowing? Shouldn't it be slowing? Aren't you guys you're wrong. You economists, you don't have it right. You're missing something, right? Am I right about that?
Yeah.
Does that feel familiar to you now in the context of what's going on? Of course, obviously, I'm talking about the tariffs and the immigration policy, right? Now, Chris, what do you think?
Yeah. Do you still advocate for a harmonized CPI?
I do, especially in the context of the long lags and the effects of what's really going on, and when it shows up in the CPI and the price measure. So, yeah, I would. Harmonized, by the way, it would exclude housing costs from the inflation measures. And that really is most important for the CPI, the Consumer Price Index, because that has a very large weight in the CPI. Less important for the PCE deflator, but certainly for the CPI. Yeah. Okay. All right. Sorry, I stopped you, Matt.
Yeah. And to kind of doubly and more evidence of how shelter has reduced as a concern. I haven't tracked harmonized CPI in about 2 or 3 months.
Yeah, I stopped. I had to think about what that was.
I'm glad you didn't ask. Yeah.
I think the BLS stopped publishing it, didn't they?
They've
had some issues in terms of.
Of course, this is before.
This is well before
all this mess that we're observing at the Bureau of Labor Statistics, right? Yeah. Okay.
A couple other major components worth touching: vehicles, global supply chains. It's always an interesting component to look at, but especially now with high tariffs, a lot of whipsawing in demand in the automotive industry. So what did we get there? We got a basically flat, no change in new vehicles CPI. So that comes after a pretty consistent stretch of lower and lower vehicle prices. So kind of contradicts or runs contrary to the expectation that tariffs are going to push up new vehicle prices. We can get into the underlying dynamics there about why that might be and why that might not continue, or why it's very unlikely to continue, that we're going to start to see price increases coming.
So
year-over-year growth.
do you expect price increases coming?
I think that's impossible not to be the case. We're
Not to be the case.
4.4% year-over-year growth in new vehicle prices, but we have the major car exporting countries in the world are getting slapped with 15% kind of a floor tariff. Of course, not all cars are imported, but a lot of inputs to cars made domestically are imported. So that's something we expect in the next couple months. I would say July really looks like an inflection point. So you have these small and incremental declines throughout 2020. In July, we get flat growth. Now we have the, I use the word durability or reliability of these trade agreements lightly, but you have something written down to say, I assume they're written down, to say that there is a 15% tariff incoming for
Someone's got it
Japanese
written down
cars.
somewhere.
Yeah, whether it's in crayon or in tweets, I don't know. But there's kind of this green light in my expectation, and talking with Mike Brisson, our auto guy, that's clarity, and you're not going to see big companies that are kind of hoping these tariffs go away.
But can I ask though? We know for example, the Japanese automakers, they appear to have eaten it, at least so far, meaning they have not cut their price that they're charging, for the cars they're sending over here to offset the effects of the tariff. So they're eating the higher tariffs, and that's a poster child for foreign producers bearing some of the brunt of the tariffs. So,
right.
Are you expecting that to change as we move forward?
The Bank of Japan released the latest, and it's really clear and interesting data point that they have. It's cars going everywhere else and cars going to North America. And like you said, there's this discount they're being sold at. We got the latest data point for July earlier this week. That trade agreement between the Japanese and U.S. governments came July 1st, 2nd, 3rd-ish. These prices are averaged throughout the month, so it's always probably going to be too early to see much. We see a little bit of an increase, but that index, that deflator, the discount, if you will, that these Japanese automakers are selling when they sell to, that they're charging when they sell to American dealerships, wholesalers, ticked up a little bit, but nothing dramatic. I would say August is going to be a month that we should watch closely for, as they can say, okay, South Korean car manufacturers are getting 15%, we're getting 15%. There's no reason to continue selling effectively at a loss. These are low cost, high volume vehicles with small margins. They were not able to continue selling at that discount for any prolonged period of time. So the expectation is that price comes up.
So just so I understand, in the most recent data, you're saying the discount that the Japanese automakers are providing, that got smaller, a little bit smaller.
A very little bit smaller.
Oh, okay.
So moved upwards.
So it's no,
yes.
Say that. Was that Chris?
Marginally.
And what you're saying is you expect that discount to start fading away here as we move forward.
Yeah, I think over time it's going to look like a V, pretty sharp V. For a period of time, we dropped prices, sold at a discount, and then it came back. And I think July was a month of an incremental marginal increase.
Okay. All right. Feel free to go ahead.
Yeah. So used vehicles, we saw an increase there, 0.5%. Still consistent with mild price pressures there for an industry that we should not expect mild price pressures to continue. So I think that's a really key component for the next half of this year. October is your new model year, primarily, not for every manufacturer, but that's when the 2026 models hit.
By the way, that's what I've heard, that's they're going to use the model year change, the automakers, even the foreign automakers. That's when we'll see the pricing, the pass through, because they're waiting for that model changeover to make that change. That's what I've heard from the Japanese automakers.
That seems very intuitive that's when you would start to embed these cost increases. So I think it still comes on a staggered amount. And of course, the BLS knows that October is typically a new year. So seasonal effects cap some of that. But the expectation is that this is a 15% tariff. If you use that as a floor, Section 232 is 25% tariff for cars coming from countries that we don't have a trade agreement with. So it's going to be above and beyond that new model increase that seasonal factors capture. So that'll be really interesting to watch. But I think it comes, I think we see just strong growth over the next, at least half of this year. Healthcare was another interesting one. And frankly, I don't have a terrific understanding of what's driving strong growth there of late, but healthcare, medical care services, 0.7% increase on the month. That follows 0.5% increase the month before.
Isn't
So
that
that's
just labor costs? I mean, that's my take on it.
it's
I mean,
labor intensive, and
yeah,
that seems like it's been a long running story, because even after the supply chain crunch and all these prices went up, it was okay, healthcare is going to be slow, but we thought that was generally a 2024, early 2025 story. So it seems a little bit more persistent, and if it continues, I would say that's likely to go even higher
right,
than we thought. But
right.
that certainly seems like the
Just
most plausible.
given the contracting process, in the healthcare
Mhm.
industry, it just takes time, for that to, again, another example of it. It's coming. It just takes time because of the frictions that are involved. But
Is that it?
that's my sense
Is
of
that
it.
an immigration story?
Oh yeah, well, I don't
Perhaps.
know. In the healthcare sector, do you think it's a restrictive immigration story, Matt?
I'm only going off of evidence or estimates that I've seen. Is construction's at the top, agricultural second in
Yeah,
terms of reliance on immigrant labor, and healthcare is in the next tier,
yeah,
I believe. So
right.
it seems plausible,
Plausible.
but
Yeah.
yeah. So that's the general story. The only
Okay.
other interesting thing I take away from the report is we're thinking about all these tariff upward pressures, but we've also long thought about the hit to consumer demand and the disinflationary effect of tariffs in the other way. Hotels is been really interesting. So you're
That's a
at
good point.
another drop in July, 1% decline. That follows 2.9% decline the month before. It is pretty volatile month to month, but you're at a year over year drop that's, excluding COVID, sharper or a bigger drop than any period since 2010, and that's not typically a time that people are thinking about as a strong consumer in America. So there seems to be a real pullback, and a lot of that's international travel, but even domestic travel. There's evidence that people are pulling back and going to hotels less, and they're forced these hotel chains are forced to drop prices. So I think that's really interesting. It's providing a little bit of a offset for some of these other price increases, but neither one of them really speaks or supports a growing economy.
Okay, so let me ask you the kind of the bottom line question. I mean, the question I'm getting is, are the tariffs and immigration policy, the restrictive immigration policy, impacting inflation? And is it impacting it in the way we anticipated, or is it taking longer to show up in the data? And taking that even further, does that mean that tariff effects, the immigration effects will not be as on inflation will not be as significant as we thought? So that's a mouthful. What do you think, Matt?
I don't think I think that's an optimistic view, but I think the evidence is that that's not what's happening. I think we're seeing staggered effects. I think the inventory drawdown, so I knew these tariffs were coming, let me buy a bunch of stuff, that's ongoing, but getting smaller and smaller every day. I think the clarity that's come from trade agreements is another reason for, big manufacturers, producers of stuff that is now being tariffed to pass through these price increases because they really don't have a choice. Looking at all that and looking at underlying components, it's happening. It's just happening at a clip that, it's not going to be 1 month where prices jump 4-5%. The increase in core CPI this month on an annualized basis would be consistent with where we think inflation peaks next year. So it is
point.
ongoing. It's just a matter of not comparing it to 9% year over year growth in 2022. It's just, this is reacceleration in inflation that's going to make things cost more. People are going to be able to afford less stuff. And we see it with stuff that's import intensive. It's pretty consistent.
Yeah, Marissa, I haven't brought. Let me bring you into the conversation. What do you think with regard to those broad questions about tariffs, immigration, and inflation? How are you thinking about it?
I agree. I think
You agree?
it is showing up in the data, but there's other stuff going on in the data, so you have to parse it out. I mean, back to your comment about how markets reacted to the CPI report, what I thought was interesting was the various ways it was described by different news outlets. Some said inflation, no signs of inflation picking up. Inflation is steady, right? Others said inflation is picking up, tariffs are coming through, right? So it can be interpreted in many different ways, as things often are by the media, but it's certainly there in the data, but you have to kind of understand how to look for it, right?
Mhm.
And I think certainly you're seeing it in certain sectors and certain segments of goods. And when we put it together with other indicators, whether they're labor market indicators to look for the effect of immigration policy or things like retail sales, which we got today, you can see that this is having an impact on the way people are spending.
Yeah, I'd agree with that. It's a delayed effect, but allow me to interject some data uncertainty here. Matt, maybe can refresh us on what fraction of the CPI is now being calculated on an imputed
Right.
basis?
Yeah, that's a great point. So the share of things that the BLS needs to assume because they didn't get out and measure explicitly a price for something is typically around 10, 12% over the past decade, or as long as the series has been available, that series. In the past few months, it's settled near a third. So 32% in July. That's down slightly from 35% in June, but it seems like, at least right now, that's kind of a plateaued point where a lot of assumptions are being made. That doesn't mean things are going to look one way or the other. It's that they're going to look in both ways. I mean, that's just a higher standard error. There's less reliability on an estimate. So that's difficult to square with a conclusion, but it needs to be taken with a grain of salt, I guess, is the
And just
right cliche.
to refresh everyone's understanding, why has the percent of imputations increased?
Generally, the clearest explanation is there's a hiring freeze. It's not that BLS, people have been
Bureau of Labor
at the BLS.
is a hiring freeze.
So the hiring freezes, BLS is not immune to that, and you have the normal flow of retirements, then they're not being replaced, and you have fewer and fewer staff to go out and do the stuff that would be normal procedures for a big report like this, and that's crimping their ability for an accurate estimate.
Chris, do you think? I'm sorry, go ahead.
I was going to ask, do you have any insight into which broad products or services are being imputed versus measured, or is there any detail around that?
They seem, and the responses I've gotten, you're not going to say, it's less clearly, hey, we're not getting out to as many department stores and watching and checking changes in denim or something like that. We're not getting to Buffalo as much. So what does that mean? And is that, so you're getting, and these are bottom up estimates. So you're cutting out some of the geographic coverage more than they're saying, we don't know what cars are costing, so we're just, winging it or something. So it's more of a geographic story. So that makes it a little bit difficult to make the durable goods. Is this a tariff? Are goods that are tariffed being estimated more, and then that would potentially understate inflation? But I don't think there's good reason to come to that conclusion right now.
That could definitely skew, though, right? Because we know there are pretty strong, persistent differences.
Well, especially
across.
Buffalo. I mean, really, you're not going to Buffalo? Are you kidding me?
Right.
You're really biasing the CPI. Brisson himself, the way he spends, He's our colleague who lives in Buffalo. Yeah, our auto guy, as Matt put it. Yeah.
Mm-hmm.
Yeah. Anyway, I should say we have because of the data issues this cropped up here, in addition to obviously what we just talked about, the firing of the former BLS commissioner and the appointment of a new one, we have our own research initiative now to try to construct our own estimates of some of these data, because I'm not sure how much we can trust the data going forward. Was it trust but verify? I can't remember what it was. That's what we're going to do.
It's a Reaganism. That's a Reaganism.
It's a Reaganism. Yeah. Well, that's what he said, right? Trust but verify. Yeah. Right.
Yeah.
So I think that applies here. And actually on prices, that's one place where we may have a good chance of really contributing, because you can go out and get the prices. And so we're going to give that a shot and, try to supplement some of the data we're getting from government sources just because of, what's going on.
We'll send Mike Brisson to the grocery store.
Yeah. We should just survey him, right? We should just survey him.
Between Mike and Justin Begley, who's also a Buffalonian, that would be a good comparative advantage for us. We can have Buffalo well covered.
Buffalonian? Is that a word? Buffalonian? I like that. Yeah.
Yeah, but Justin doesn't live in Buffalo.
Yeah, he's a Tallahassee now.
Yeah, but he goes back a good amount. I'm sure we could get him to split his time.
He can do that in his free time.
Maybe we should offer Justin and Matt and Mike up to the BLS. Maybe say, hey, we'll help you. So you don't need to go visit Buffalo. You can interview these two guys. What do you think?
They can be interns because they won't be.
The way that BLS is going, that might really work for them. I don't know.
Yeah,
a voluntary organization, I guess.
Yeah, right. All right. Okay. Well, talking about the imprints of tariffs and immigration on the inflation numbers, Matt, the PPI, the producer price index. What the heck?
Yeah, I thought it was a typo when I first loaded the report. It was 0.9%, which is also, bigger swings in producer prices. What producers firms are buying stuff, the inputs they use in their operations. It's a little bit more higher movements than the consumer price index. But a 0.9% increase from June to July. Plus consensus, we were all about 0.2%, so way under. The underlying factors are really interesting here. Whereas we had a decline in energy prices for the consumer price index, energy was actually a bit of a boost to producer prices, but that I think should not, even you exclude energy and you start to look underneath the hood, It's a pretty concerning report. So that 0.9% increased the final demand PPI, which is kind of the standard everybody refers to, from 2.4% in June to 3.3% July. Food prices took a big jump. And behind that, we see vegetables in particular about 38, 39%
about? Is
higher.
that tariffs on tomatoes from Mexico or something? What's that about?
I think that's a reasonable expectation. You have a lot of
Or
stuff
immigrants.
coming from
Or
agricultural
is it
costs.
immigration again?
Well, immigration again. Yeah, right. Immigration again. That makes sense.
Could be both.
Could be both. Right. Sorry, Matt.
No, I think that's a really good call for what could be driving up farm prices and agricultural products. We see meat and veal, a lot of that. Again, I know Brazil's a big exporter of beef.
Coffee.
Jumped really.
Wasn't coffee?
Coffee is a huge one. Roasted coffee prices are 30% higher right now than they were a year ago.
And that's tariffs, right? Isn't that tariffs on
It's
Brazil?
Almost all. So 14% of it is just in the past 3 or 4 months.
Yeah. Right.
So beef and veal moving the same direction, 10% in the past few months. Fruit prices would be subject to some of the same labor constraints that Chris mentioned there. It's been pretty tame, but I don't think there's a reasonable expectation that they're going to be immune from higher costs. Other components, home electronic equipment, jump 5%. A lot of that's these are coming across the Pacific. These are made in Asian countries. A lot of Chinese components. That's a major increase. Household appliances are, we're starting to get back to, this is the highest year-over-year rate since the supply chain crunch. So 2022, 2023 is we're hitting kind of those superlatives. Really interesting that we're not just talking about goods here. We're looking at a big jump in services prices. Looking at what's underlying there is this component, trade services, which is essentially looking at wholesalers and retailers, the margins, so what they're buying for. Then they're buying a component and then they're selling that component. What that margin is, so it can kind of proxy a profit margin, but there's a lot more that would indicate that goes into that suggests it's not just them padding their margins, but it is functionally saying American producers taking these prices on the chin, or are they, hey, my costs are going up, so I'm going to pass that along? So the movements there are really interesting. And we got a 2% increase in July. And that's, again, it's a relatively unintuitive measure, but that's probably the most informing data point in July's PPI report, is that margin is not shrinking. If it were shrinking, that would be, hey, higher costs. We're getting those Mexican tomatoes and they cost a lot more for us, but we're not going to pass that on to consumers. Because it rose.
Did we see any compression in the margin in previous months?
There was about 3 months ago. There was a big drop that then the next month. So that was a potential argument that firms are taking this, eating higher tariffs.
Well, they were
and then
eating it, and now they're getting clarity around the tariffs, and they're saying, hey, now I know where these tariffs are going to land. I'm going to start passing through these tariff cost increases to my customer, restore my margin. That would be a narrative. That's kind of roughly consistent with the data.
But even that big drop was revised away, still negative, but like it went from a negative 1.4%, and the talk was, okay, wholesalers are taking these tariffs on the chin, and then the next month it was negative 0.3, so okay, not that much. And then since then, it's been a story of expanding margins, which is they're keeping. They're not widening their margins as much as they're seeing higher price increases and protecting their margins is probably the clearest way to think about that.
But your takeaway here is that this argument that businesses are going to eat these tariff increases, at least on a sustained basis, that's not consistent with what you're observing here in this data.
No, you would see those contractions would be the countervailing narrative.
Okay. So let me ask, PPI, Producer Price Index, the way I've thought about that simplistically is that's what businesses kind of charge each other, for components, as you say, and other inputs. And that is a bit of a leading indicator for consumer prices. So, businesses, price for the different things that they need, then they use that to determine what price, along with their margin, what price they need to charge to consumers. So if producer prices go up 0.9% this month, that doesn't augur well for CPI next month or the month after or the month after that. Is that simplistic way of thinking about it an accurate way of thinking about it?
I think it is. I mean, that's how this should be evaluated.
Okay. All right. Okay. So you add this into the mix, CPI, PPI, again, just reinforces your view that, the tariff and immigration effects they're here, they're showing up in the data, and they'll become more pronounced in the months ahead.
Yeah, clearly.
Okay. All right. Marissa, any pushback there? Is that your view?
No.
You got it. Okay. And Chris, same deal?
Yeah.
Okay. And I should point out, we have not changed our forecast with regard to inflation. I mean, if you look at our CPI, the CPI, I haven't looked at the PPI forecast, but the CPI forecast, the PCE deflator forecast, and we'll get to that in a second. That's the consumer expenditure deflator measure of inflation. That's the measure the Fed uses when setting its interest rate policy. That, what we've been expecting in that forecast is about the same as what we were expecting last month, what we were expecting 3 months ago when the tariffs really got jacked up. Nothing's really changed. Okay, so what does this all mean for that PCE deflator, Matt? So I know the CPI numbers, the PPI numbers are used as inputs into the calculation the BLS makes to calculate PCE, again, the consumer expenditure deflator. What are you now expecting that to be, the PCE deflator for the month of July, when we get that? I guess next week after.
2 weeks.
2 weeks,
Yeah,
yeah,
the following
2
weeks. The headline PCE deflator is expected to rise 0.19%, so rounded up to 0.2.
Okay.
That'll keep the year-over-year rate at 2.6. Core PCE 0.28%. That follows 0.26. Both going to be rounded up to 0.3 in June, and that will lift the year-ago rate from 2.8 to 2.9. And I have to say, after I initially looked at the PPI, I thought, okay, this isn't a typo. Wow, this is really going to drive strong PCE, depending on which components here get mapped over to the PCE. And the story there is the components that are within a PPI report that are used in the PCE deflator were relatively mild, so you don't get this really strong jump in the PCE that was potential. Kind of determined by which components in the PPI drove that headline increase. So, that's a lot of kind of methodological talk, but in general, it'll look pretty similar to the consumer price index report, where you see core inflation picking up and year-over-year growth getting further and away from the Fed's target.
So core PCE up rounded 0.3 on the month, 2.9% year over year. And of course, that 2.9%, we often think of that in the context of the Fed's 2% inflation target, because they're targeting, that core PCE deflator. Inflation is uncomfortable. The way I kind of why I would characterize that would be, that's uncomfortably high inflation, 2.9 versus 2. 2 is deemed to be comfortable and appropriate. We're at 2.9, so almost a point higher. That's uncomfortably high. And the direction of travel is, auspicious, moving in the wrong direction. It's going up. And that's what we should expect to see continue through the remainder of the year into next. Anyone disagree with that? That's our forecast. Anyone disagree with that? No. Okay. All right. Anything else on this? Anything else that you want to call out, Matt, on the inflation front?
No.
Okay.
I think that was a good synopsis.
I guess the only other thing I'd say is, we've all been focused on tariffs. I think we also need to, and Chris has made this point implicitly, we've also focus on the effects of immigration, the restrictive immigration policy, which it feels like that's going to intensify, because in the big, beautiful bill, there's a lot of money for border security, wasn't there? I mean, that feels like, yeah. So it feels like that's going to intensify here. By the way, I had a piece in the Washington Post op-ed on this issue. In case you missed it, guys, you might want to take a look at that. It was a pretty good piece. Okay, that's the inflation data. On the growth side of this, I mean, obviously we're concerned about inflation created by the tariffs and immigration policy, but both those policies also have implications for growth. They weigh on economic growth. I guess correct me if I'm wrong, Marissa, the key statistic that came out this week was today's numbers on retail sales. Is that right? And what did the retail sales numbers say?
Yeah, that's right. Retail sales for the month of July came out today. So it showed that total retail sales and food services rose 0.5 percentage point between June and July. That follows a 0.9 percentage point increase in June. If you take out autos and gas, which tend to be volatile from month to month, retail sales in July were up, following a 0.8% increase in June, which implies, and is the case, that much of the growth this past month, July, came from auto sales. We saw a pretty substantial pop in motor vehicle sales, and that was the second month in a row we've seen strong motor vehicle sales. Across the rest of the major categories, it was kind of mixed, but we do see weakness, interestingly, in some things like restaurants. So food service, drinking places, sales fell. We saw declines in building material stores and electronics and appliances. And we know, Matt has said both of those categories have shown some increase or some evidence that prices are rising. There may be some tariff pass-through in those categories. And then elsewhere, things were mixed. So like clothes stores, sporting goods stores, and especially online retailers. So internet sales were were okay. They were pretty robust, but this was really very much juiced up by auto sales this past month. And if you take a kind of a broader view of retail, that sounds kind of like a good picture, relatively, right? But if you take a broader view of retail sales and you look just since the start of this year, retail sales are up 2.1% on an annualized pace. And that is about a third of the pace that retail sales were growing if you compare it to the last 7 months of last year. So they've slowed quite significantly this year,
Can you say that again?
despite the vagaries of the up and down.
Can you say that one more time? What that last
Yeah,
bit?
so over the first 7 months, so
Yeah.
kind of year to date,
Right.
retail sales are up 2.1%.
This year, they're up 2.1.
This year,
Okay,
right.
2.1. Annualized?
Yes, right.
Annualized, okay.
Yeah. And that's about a third of the pace of what they were growing at last year.
Wow.
Yeah. So we've definitely seen a weakness so far this year when you compare it to, what we were looking
And
at
that's
coming into
nominal.
the
That's
early of the
before
year.
you account
And
for
this is
inflation.
nominal. That's right. So this is not being discounted by the rate of inflation. That's right.
So in my mind's eye, if it's 2.1% annualized first 7 months of the year, goods inflation has been at least that, probably more than that, right?
Probably more than that, right?
And that would suggest that so-called real retail sales, the real spending after inflation, is actually negative in the
Yeah.
first.
Yep.
That's a good statistic. That would have been a great statistic for the game. I'm just saying.
It would have been.
That's a good one. Really good. Okay, so what's your kind of bottom line takeaway from all that? That the consumer is. Well, I won't put words in your mouth. What's your takeaway?
Yeah, I mean, I think there's some evidence here that consumers are still kind of trying to get ahead of expected price increases. You see that in the vehicle segment, right? We saw that earlier this year where there was, in the first couple months of the year, there was a lot of buying of cars with the expectation that tariffs were going to be pretty substantial. And I think over the past couple months, we're seeing that again. We're seeing it with the electrical vehicle tax credit. The $7,500 tax credit expires in the end of September. And there's some data to show that people are buying electrical vehicles to take advantage of that tax credit now before it's gone. I have friends that just bought an EV this past weekend.
Because of the credit?
Specifically because of that timing.
I see.
To do it before the tax credit expires. So I think there's still some wonkiness in the data and the way people are spending to try to get ahead of tariffs.
Matt, I know you watch this data too. You watch all the data very carefully. Any comments on the retail sales numbers? Or
Yeah, the inflation adjustment part is really interesting to get a sense of where people
do you have a
actually
precise number? Do you have a precise estimate of?
I mean, I look at real personal spending, and it's flat for the year. If you go from
the year, yeah.
from compared to late
The
2024
goods
to today.
inflation, the so-called that go into the retail sale, for the goods that go into retail sales. Do you have any sense of what that inflation has been year to date?
No, I don't. And I think it's produced. I just haven't looked at it.
I'd be very curious. Sorry, go ahead.
Yeah, it's the consumer pullback. It's almost perplexing a little bit because still is a low unemployment rate, but is it really these concerns about where tariffs are headed and all of this growth uncertainty? Is that where people are preemptively just spending less? I think that's the conclusion that's most probable, even if it seems it seems like a strong psychological effect, especially after we had a period where consumers were saying a lot of bad stuff.
Well, the
and
job
they just kept
market's weak,
spending.
Matt. The job market's not good, right? We know that, right? I mean,
It
job
is,
growth
but
has pretty much
there's
come
not-
to a standstill. I mean, I know it's not because of layoffs, but there's no hiring. So people sense that, don't they?
That seems undeniable. That's what they sense, but I would have attributed lost income to being needed to. Okay, people are losing their income now. I'm not going to spend. Not hey, I might lose my income. That pass through or that channel seems stronger than I think.
Right.
I mean, what I would have guessed, especially because consumers have been really negative for a long time and they've just continued to spend. Now they're negative and they're not spending, and I think there's good reason for that. And I think it's the factors behind why they're so negative have changed, and that's an important difference. But yeah.
Well, that doesn't augur well. I know I've made this point in previous podcasts, but so far at least, real incomes have kind of held up, but that feels like that's going to come under some real pressure here as these price increases due to the tariffs and immigration policy start to flow through. Unless wage growth accelerates, we're going to start to see, some pressure on real incomes, and then spending, that, to your point, to the impact on spending. Chris, how do you interpret to Matt's, point about why we've seen this not pretty. We have seen this clear plateauing, flattening out of consumer spending, real consumer spending. It's kind of gone nowhere, since the beginning of the year after growing steadily and I'd say even strongly in the years after the pandemic. Is it just psychological? Is it people that are just nervous? I mean, what's going on? What do you think? What's fundamentally behind that?
No, I think there are some real drivers here. People are sensing weakness, and in particular, right, it's the upper end of the households, upper income households that are
Right.
really flattening out their spending and having the biggest effect, if you will. So I think there's certainly some of that going on. There's also it seems like, to Marissa's point, there's a lot of this eye of the beholder effect going on here when it comes to the investor community looking at this data and just saying, oh, well, it's not as bad as it could have been or what consensus might have been. The retail sales are still growing. So, I think there's just some mixed signals here in terms of which specific segment of the economy we're looking at, whether it's high versus low income consumers or investors, or just a lot of signals here. And the tariffs just change all the timing and make it very difficult to get a clear read on what's going on.
Okay, well, from my perspective, bottom line, it's clear that inflation's picking up and growth is slowing, and that's directionally stagflation. We're going in the wrong direction here, and the fingerprints of the tariffs and the immigration policy are all over the economy's performance. You would agree?
Yes.
Yeah. Okay. All right. Okay. We've got 2 ways to go here if we're going to keep this podcast at a reasonable length, because Matt was prattling on to no end. That he was. I think he was even showing off a little bit. Don't you think? Pretty granular understanding of that whole margin thing with the PPI. I thought it was pretty.
It's very impressive.
It's very impressive.
I'm impressed too, actually.
Yeah. And that's the way it should be. That's the way it should be.
Yeah.
Should we play the game, or should we just go right to let's just go right to listener questions. We'll play the game next week. How about that? Does that sound okay? Okay.
Solid number.
Oh, did you really? All right, let's play one round of the game. Let's play one round of the game for Matt.
Okay, Matt,
you're on now, baby. Or you just making that up? You were just making that up.
I do have a good one. This is also a good time for you guys to humor me. It is my birthday too, so you guys are being extra nice to me. Oh yeah.
Wow! Happy birthday, Matt.
You guys don't know that it's not in your Outlook calendars?
I didn't.
I don't even have my birthday in my Outlook calendar. What are you talking about?
I was joking. Nobody should have that. All right. Well,
you look like you're. How old does Matt look?
Oh, gosh, don't play this game. Don't play this game.
A lot younger than me. Let's put it that way. Yeah. Anyway, okay. Let's play one round of the game for Matt's birthday present.
I appreciate you guys.
So this is you're giving us a stat that isn't so easy. We get it right away. One that's not so hard. We never get it. And I'm guessing it has to do with inflation, but we'll see. So go ahead, Matt. What's your stat?
0.25%.
Is it inflation related?
And yeah, it is.
It's not a CPI in the CPI.
It's not.
It's not in the PPI.
No.
It's not in the consumer expenditure deflator.
No.
Is it related to inflation expectations?
No.
But it is related to inflation. 0.25%.
Came out this morning.
Import prices.
Oh, there you go, getting there. So now it's just a transformation.
What did you say,
For the sake of getting to the
import prices. He said import prices.
Yeah, Chris. For the sake of getting to the listener questions, 0.25% is the change in import prices ex petroleum since the beginning of this year. That's not that sexy by itself, but if foreign companies, just based off the arithmetic of how these import price indexes are calculated,
right.
If foreign companies were doing what we said the Japanese were doing at scale, you would see the falling import price index because these are separate. Tariffs are separate from how these prices are calculated. So it's flat. It's up a little bit. What that means is that foreign companies, to any large macro degree, are not eating these costs and selling at a discount, so that when the domestic firm cuts the check to customs, they're all kind of made whole, and then prices go on as they were with the balance sheet hit going to the foreign exporting companies. Yeah, so it's more of a matter, and you link that with what we said about wholesalers' margins. It's kind of only one place left. If foreign companies aren't eating it, domestic firms aren't taking it on the chin to the extent, if they ever were, they were to some degree. We're getting all this tariff revenue, allegedly, from the Treasury, so it's going somewhere.
Allegedly.
There's a hit.
Man, you're such a cynic. Allegedly.
I wasn't always. But yeah,
what does that mean? Allegedly.
Allegedly, I would have never You mentioned our
Never
workflow about
mind,
the, yeah,
Matt.
okay,
Never
okay,
mind.
He's
okay.
become
Yeah,
rooted
thank
in
you. So yeah, the
Yeah,
consumer
but your
price
point
story
is
is
we're collecting tariff revenue. So an American company or consumer has to be paying it, right? By definition.
if these other two places are not absorbing it. Yes,
Yeah.
I'm not a conspiracist, by the way. I was just throwing it out there. But
Can I ask, how old are you? No, but you don't have to answer.
58.
You're
No,
58?
You look great.
I am a square number today. 36.
Oh, congratulations.
Yeah.
36.
Hey,
I wish I can't remember 36. That was too long ago for me.
yeah.
36. Yeah, you're a young father. Yeah, that's what
Sure.
36
Yeah.
means. Good times. Those are really good times. Okay, hey, Marissa, we got a ton of questions.
We do.
Let's go to the cues. What do you got?
Okay. I have so many. I like this one. All right. What is your take on which economic risks are getting more attention than they deserve right now, and which ones are flying under the radar but could shape the economy for years to come?
Oh, that's a really good question.
Mm-hmm.
So
This is from
which
Cameron Soliman. These are from LinkedIn, by the way.
which risks are getting too much attention? Which risks are underappreciated? I'm sure I mean, this is one of those questions while I'm running, I'm going to be cogitating over, and I'll come up with a much better answer. But on which are getting more attention, it's the so-called geopolitical risks. I think they tend to get more attention than is appropriate in the context of what it actually means for the dollars and cents of the economy here in the United States. Not that they're not important, and not that they don't, when I'm saying that, I mean Russia, Ukraine, what's going on with Gaza, concerns about North Korea, those kinds of things, those geopolitical risks that get a lot of headlines. They could certainly metastasize into something that's, a big deal. So I'm not saying they should not be on the radar screen. We should be thinking about them, running scenarios to prepare for the possibility that they boil over. But for the most part, generally, they're tail risks. They're on the tail, and they don't have any kind of meaningful impact on what's going on here, our economy. And the links here are very tenuous and hard to identify. In the case of what's going on in the Middle East, of course, it would be oil prices, but even there, it's pretty much of a stretch when we're thinking about, Israel bombing Iran's nuclear facilities, or again, what's going on in Gaza, that kind of thing. So I tend to think that geopolitical risk is overstated as a risk, at least again, in the near term. With regard to what's underappreciated, I think it's more about the risks that these policies that we've been talking about pose to long-term economic growth. We're all focused on now, what happened, this month, this week, today, the stock market, the bond market. But these policies, if they stick around for any length of time, they're going to have very significant corrosive effects on the economy's long-term growth prospects. And I think you can see that in the context of Brexit. Brexit was 2016, and you just take a look at a graph of UK, British GDP, and you can clearly see an inflection point around Brexit. The slope of the line representing UK GDP is now lower post-Brexit than it was before. And I think that's the kind of thing, we face here, that, with these kinds of policies, our long-term growth prospects are diminished. And I think that's underappreciated because it's natural, because we're just focused on the here and now. I don't know, Chris, tough question. How would you answer it?
It is a tough question. At least the first part I found tougher, but I'd agree with you in terms of the geopolitical risks as being overstated. I guess in terms of underappreciated, for me, it's institutional erosion. Whether it's the Fed, independence, or other
Right.
institutions, I think there's a real
Totally.
long-run corrosive effect that, investors certainly are not really paying attention to any significant degree, but could come back to really harm us in the end.
Totally agree with that. That's a great one. Marissa, do you have a view on that question?
Yeah, I think I agree with you on the overstated risk to the U.S. economy. Direct risk to the U.S. economy.
Right.
I think with the underrated risks, I agree that some of the policies that are being put into place right now could have very detrimental long-term impacts. And in particular, I'm thinking about sort of the gutting of science and research, the policies that are dissuading foreign students from coming to work and study here. I worry about what that means for our longer run human capital in this country. I worry about what it might mean for things like preventing the next pandemic, things like that. I think these have really potentially dire consequences further down.
I just want to throw one other thing out there with regard to the question about what's the risk that's overstated. And I'm stretching here a little bit, and I might be overstepping, and I might change my mind. Let's put it that way. Is AI's impact on jobs? I think the more I live the AI, and we are living AI. We're using it. The more I'm coming to the conclusion that no, this isn't going to reduce jobs. We'll raise productivity growth, no doubt about that, because the quality of what we're producing is definitely on the rise because of AI, which means that effectively real output is increasing. Therefore, even with the same labor hours, you're getting more productivity. But I'm increasingly of the view that this AI technology is not going to significantly reduce jobs, employment. So that concern is, if you have it, again, I reserve the right to change my mind as I think about this more and we do more research. But that, I don't know, Matt, what do you think? Do you have a view on that?
Then the inverse of that is you think maybe we're underestimating a stock market sell-off, because if AI doesn't hit all of those stratospheric expectations, then the S&P is going to fall pretty strong.
Well, I don't know. Is that right? Because we're still going to get the productivity gains, right? We're still going to get, although I guess I have to think about that, right? Because I'm arguing higher quality. I don't know if that benefits the companies in terms of earnings, right? Which is what ultimately matters for the equity market. So that's a good question. I think about that. I know, Chris, you're kind of on my page when it comes to this, right?
Yes.
The IFX. Yeah. Okay.
I totally disagree with you.
Totally
I think it's
disagree.
gonna have,
Okay.
Totally.
All right. Oh, wait,
Yeah.
baby. I was
Nice,
waiting for
nice.
that.
Let's go.
Yeah. And I wasn't even going
I
to
think
call on you. And boy, what a
I
mistake
know,
that would
that's
have
why I
been.
jumped in.
Yeah, there you go. Okay. Fire away.
I think
You
it's
just
going to
disagree.
have, I do. I think it's going to have a massive impact on the labor market. I just don't think it's going to be this year, next year, but I think eventually it will. And I think it's going to be more of a displacement or a reshuffling, right?
Yeah.
I think a lot of people are going, I think a lot of jobs may disappear or change,
I'm not arguing
particularly
that.
white
Don't get me
collar
wrong.
jobs.
Now, just to be saying the number of jobs, not the kind
The
of
net
job.
you're saying the net number of
Net
jobs.
number. Yeah.
Yeah.
New
Yeah. Okay.
industries
I
will
mean,
be
I think,
created, right?
yeah, I think
I'm
there'll
definitely,
be,
there's going to be all kinds of
okay.
churn. Yeah, for sure.
Yeah, yeah. But I do think there's going to be a seismic shift in the labor market. And I think you're already kind of seeing a bit when you look at hiring right now, especially for kind of entry level, right out of college, right out of high school type jobs that many of which can be automated. I think that that's partially an explanation for why some companies are not hiring a lot of entry level people right now. I think there's a real shift underway to try to do some of the sort of more rote tasks using AI. I think it's subtle because it's probably not massive enough right now, but I don't know. I think it
For net
I just think it
job
might be
loss. So
5,
people
10
you're
years
going
down
to
the
have a higher
road.
unemployment as a result. So our forecast, we've got improvement in
Yeah.
GDP and output in productivity growth. But if you look at the number of jobs and more and what it means for unemployment, really
Be stable.
pretty
It's
stable.
kind of a wash.
It's kind of a
is what you're-
wash.
Yeah.
I lose
yeah.
jobs over here. I gain jobs over here. I may see
Yeah.
some reduction in labor hours. Maybe. I don't know. I think even that's a stretch. But that's kind of what I'm saying. Not that, because kind of the strong view of many is the net number of jobs is going to be meaningfully millions of people lower, millions of workers lower, a decade from now than exists today because of AI.
Mhm. Yeah. Okay. Yeah. Yes. I think it's going to be massively impactful to the labor market, but I think on net, it is going to also create a lot of jobs. You're right. Yeah. Okay.
And it's going to occur in phases, right? There's going to be that cost-cutting approach first. How can we use this technology to do this, produce the same output but with fewer people? But then, as soon as we get that, we're going to say, "Oh, what else can we do with this? And
Mhm.
how can we actually leverage it in a way that is not just replacement. It's actually opening up a whole new avenue or industry that we haven't even thought of before. At least that's how if you look at previous tech cycles, that's kind
Right,
of what
right.
happens, right?
Yeah, it could be actually that it's a nothing burger, nothing, nothing, nothing. We have recession. And that's when companies say, oh, okay, now I'm going to adopt this new technology wholesale. And you actually see a level step down and it comes back. But, as part of the recession, you see kind of this purging of labor. Well, fortunately, we've got, ask Jared Franz. He's the chief economist of Capital Group, the major investment house. He's done a lot of work in this area to come on in the not too distant future to talk about it. He's done a lot of work in this research. I think he's pretty, I don't want to front run, but I think he's more pessimistic about this in terms of what it means for jobs. So that'll make for an interesting conversation. Anyway, okay. See how we took that question and we just ran with it. 10 minutes later.
This is why we don't get through many questions.
Why we don't
Because
get through
each
too many
question
questions.
takes half an
It
hour.
really, but that was a really good one. Anyway, you want to ask another one?
Sure. Here's one. Housing is clearly in a recession. If the rest of the economy is still doing well, what tools does the Fed or the administration have to bring down mortgage rates quicker while leaving the short-term Fed funds rate where it is, or bring it down slowly?
Well, Chris, that's kind of right down your strike zone, right?
Yeah. What Fed does the tool at, right? They could engage in purchasing MBS securities, right?
Mortgage securities.
Mortgage-backed securities.
Mortgage-backed
That would
securities.
certainly put downward pressure on
QE.
rates.
Go back to
QE.
QE. Quantitative
They
easing.
could. They probably won't, but that certainly would be an option. It's more on, and the Fed has always said, look, we're not in the business. This is not really our part of the economy to manage. This is more on the federal government side in terms of, getting your budget in order, reducing deficits, reducing debt, right, to bring in longer term rates. And then certainly attacking the supply problem. That's really where, at least in our view, much of the work could be done to, get house prices at least to slow down. And if not interest rates, that would certainly provide some additional affordability to homeowners.
I guess there's also the regulatory aspect of this, right? The Fed has significant influence, at least right now. That may change, but right now, at least, it has significant regulatory authority. But I think isn't there, and so they could adjust capital rules to make it more advantageous for banks whom they regulate to mortgage assets and more MBS and mortgage loans, and that would help improve availability and cost of mortgage credit. I assume that's more circuitous. I mean, the QE is direct. I'm going to go out and buy. And mortgage securities, that directly brings down interest rates brings down mortgage rates. So that would be their direct way of doing it. But the regulatory changes could also work in that direction, but that would be much more circuitous and take more time. That's a possibility as well. But I guess that begs the question, do we, I guess we do, mortgage rates are elevated and they are part of the problem, especially on the existing home side in terms of home sales and the interest rate lock that's weighing on home sales. But you're kind of saying, Chris, the more fundamental issue is just, more supply, more new housing supply.
That's right.
Housing supply.
That's right. We do know that the spreads
I
are
can't do anything
elevated.
on that. Yeah. Right. Go ahead. Sorry, Chris.
I was going to say mortgage spreads are still quite wide, right?
Yeah.
The difference between the interest rate on a mortgage, a 30-year mortgage, and the 10-year treasury. And we've attributed that to different players on this podcast. One of them is I think the reduction in investor demand, just foreign investors pulling back, other investors pulling back, and that has caused some of the widening. We also have some interest rate volatility out there that investors need to price for. So just a more stable, steady economy should bring those spreads in and bring the mortgage rate in as well.
I wonder on the other side of the next Fed chair and this push for lower rates, and clearly there's been a lot of interest, in policy circles in Washington about getting mortgage rates down to address the interest rate lock. I wonder if we might not see the Fed actually QE and go buy mortgage securities. That goes back to your institutional erosion, I think. But that feels like that's a direct way to get mortgage rates down if you want to get mortgage rates down, right?
Sure.
Yeah.
Sure. At least for a time.
At least for a time.
And then I guess you'd also have to start buying more treasuries as well, because investors might get spooked. And you want the longer term debt to
interesting
come in,
point.
so
That may not
you
work.
might have to go all in.
It might spook investors and say, oh, what the heck's going on here? These guys whoever's managing monetary policy isn't focused on low and stable inflation. That's not what they're focused on. Therefore, I'm going to sell treasury securities. Thus, if I'm at the Fed, I got to start buying those too.
More. Exactly.
So I just got to, we're in the financial repression world at this point.
Yes.
Yeah.
Yes.
Interesting. Okay. Another very good question. Take another couple. You want to, Marissa,
Sure.
you want to fire away?
So here's one that's sort of emblematic of a lot of the questions. There's a lot of questions around data quality, just given what's happened in the past few weeks with the BLS commissioner, right? So here's one question. If the new BLS commissioner is successful in pausing production of CES estimates, because he has suggested in the past that BLS should not be putting out data that gets revised, right? That they should basically put out one jobs report 3 months after the month it's collected. So if that happens, what indicators will you be looking to for a timely signal of how the labor market's doing in its place?
Yeah, this is what we're contemplating. This is a tough one. I mean, I think what happens, and just to make clear to everyone out there, we're talking about the monthly jobs report, and CES is the payroll employment. That's where payroll employment comes from. And that's obviously the headline number, in the jobs report. And it's very timely, comes out the first Friday of every month for the previous month. And so it's the best, most timely read on what's going on in the economy. And payroll employment is the single best coincident indicator of economic activities. Even though when it's first released, we only have 65, 70% response rate. And that's why you get revisions when you get, subsequent responders in subsequent months. There's a lot of information, really important information in that first release. So not releasing that on a timely way is a massive error, because it makes it complicated for the Fed to conduct policy, for businesses to do what they need to do. It creates more uncertainty, which means that businesses are going to be more cautious in hiring, investing. It's just I couldn't think of a worse policy mistake than doing that. In fact, you should be doing just the opposite. You should be providing greater funding for the BLS so that they can do even a better job in making it easy for businesses to respond to the survey so we get higher response rates. And clearly go out and try to understand why response rates are down and what needs to be done to improve them around cyber or privacy or whatever it is. We should be spending more taxpayer dollars and trying to improve it, not just shutting it down for 3 months and wait for that data to be released. And by the way, when you say revisions, the data gets revised again anyway when you get the benchmark revisions. So what are you going to wait another year before you release the data? Come on, it's just I've got stronger words to say than bad, but it's bad. It's a bad idea. But having said that, if that's the world we live in, I do think what happens is we start relying on private data sources, which, by the way, could show a worse economy than the BLS. When I say a private data source, ADP, the payroll processor, the human resource company that we used to work with closely for many years, we produced that number and they still produce it. And actually, they made a change, which I think was entirely appropriate. Instead of trying to estimate the BLS number, which is what we were tasked to do when we were doing it, they produce another number, just a separate number. I mean, they've got a very large number of employers that are contributing, that are their clients and are contributing that are providing that data that can be used to estimate what's going on in the job market. And, I think ADP will become the de facto source, and in fact, right now, the ADP publishes its data on the Wednesday, prior to the Friday jobs numbers that are released. So it's, we're going to get, it'll continue to be very timely, very, very valuable data. I think this is in my mind's eye. I may have it wrong, but I think if you look at the ADP estimates for monthly payroll jobs over the past year or so, it's actually very consistent with the BLS numbers. So, BLS stops, then all we're going to do is go to ADP. And, ADP is, as I said, it's not going to stop if the economy's going south into recession, we start losing jobs. ADP is going to be saying that, and it's not going to be discounted because the government's not releasing the data, but ADP is. So I'm not sure what it buys you when you decided to go down that path. Well, of course, we'll also look at other measures, other indicators more intensively. Well, the unemployment insurance claims, although that's a BLS statistic, will they change the release of the BLS numbers if it starts showing that UI claims are starting to rise? That's a good window into layoffs. There's other placement firms that provide data on unfilled positions, and we'll start looking at that more carefully. Going back to my original point, we have an research initiative to come up with alternative data sources. We're going to focus on prices first, but we're also going to focus on jobs and see if we can't figure out ways to provide some information here that might be left in the void created by the BLS not publishing the number. Hopefully they decide not to do that. That again would be, Matt, what did I say? Bad idea, a really bad idea. I don't know. I've got on my soapbox a little bit, but I think it's appropriate. Marissa, you're a labor economist. What do you think? What would you say?
Yeah, the thing about ADP is ADP, part of that is model-based that uses the BLS payroll data in it. So if that is lagged, right, then that actually affects the ADP number in a way too.
That's benchmark though, isn't it? To the benchmark?
Yeah, but they'd have to change their methodology somewhat if that happened as well. They'd have to, I guess, go to just a pure count of their own payroll data.
No, but don't they do? And I don't know the methodology well enough, but my understanding is they bench their data ultimately to the benchmark estimate. So that if the BLS continues to release the benchmark estimate on time, I don't think it necessarily means ADP has to change its methodology.
Okay, maybe that's true. I thought there was some.
We should find out though. We should find out. Yeah, that's
the payroll data.
We should get prepared for this possibility for sure.
Yeah. And like you said, the UI claims, which is not a BLS statistic, Mark. It's from the Employment Training Administration, which is part of the Department of Labor, which is under pressure.
Right.
And just to go back to what you were saying about funding the BLS properly, I was looking at their budget and their head count, and they have not had an increase in their budget in 15 years. I mean, it has been basically flat at a time when it's become increasingly harder to collect data from survey participants. So if you want higher quality data, you have to actually put some money behind that and come up with ways to modernize these surveys, which is one of the stated goals of the administration in replacing the BLS commissioners, to modernize survey collection. But you need the funds and the resources and the people to be able to do.
Anything else, Chris or Matt, you want to weigh in on that question?
Bit of a pivot, but I've come across some interesting stuff. Like, how is Congress going to respond if they're flying blind to, if there were a recession and there needed to be, stimulative legislation or stabilizers for the unemployment rate? I mean, all that kind of stuff that a recession usually kicks off. Is that going to become kind of a loyalty? I mean, kind of, to acknowledge that would be like a tacit admission that data is wrong. I mean, that just seems like a kind of obstacle that we could be looking at in not so distant future that will make a bad economic situation worse. So not good.
One more. Let's do one. Oh, Chris, did you want to say something?
I was going to say that the biggest risk here I see is the Fed, right? The Fed not having information,
right?
Timely information. They're going to make a decision. It's probably going to be faulty. So there's certainly a risk there that there's some policy misstep. We get our monetary policy wrong because of the lags or the incomplete information that we have, even from a private source like ADP.
Okay, one more question, Marissa.
Okay, we've answered quite a bit, and I think we've answered like many indirectly too.
Oh, okay.
Okay, here's one. There seems to be two schools of thought on the state of the economy. One, inflation is on our doorstep, or it's already advancing too much. Or two, the economy is super, cut rates. Pieces of both seem to be evident. Can you reconcile this and share what would be a rational approach by the Fed in terms of next steps and possible consequences?
Chris, you want to go first? I mean,
sure.
I can take it. You want to go? Go ahead. Go ahead. You go first.
Yeah, I guess as we've been saying throughout the podcast, there are kind of different lenses that people look at when they look at the economy, and different sources of news can translate the same data point in a very positive or negative way. So I think that can explain some of the differing views here. Also depends if you're looking backward or you're looking forward, right? A lot of the data that we collect, of course, is more backward looking, right? We get a job market report that's telling us about last month, or we learn about GDP a quarter ago. So maybe we get some updated information about where we've been, but that doesn't really tell us where we're headed. I think when we talk about tariffs, at least the argument we've been making is that, there are lags in this process. There's a lot of uncertainty that's been going on when it comes to policy. And therefore, we believe more of the tariff effects are still ahead of us than behind us, right, in terms of the actual impact on prices. So that's how I square that circle in terms of the differing views. If you don't account for the lags, if you're just looking at the data as it comes out today, then you may not get the full picture, or you may get a different picture relative to where the economy may actually be heading in the future. And I think that's what we actually really do care about.
Is the forecast, the outlook.
Is the forecast, right? The past is important just to the extent that it can help us predict the future.
Yeah, good. Okay. Well, I'm not going to weigh in there. I think you covered it. Anything else before, because we're now really amazingly long in the tooth in terms of this podcast. I don't know how that happened. I just looked at the clock. I kind of missed that, but we should call this a podcast unless anyone has anything else they'd like to say. No?
Happy birthday, Matt.
Happy birthday, Matt.
Yeah.
I appreciate it.
Should we sing to him?
I appreciate it.
Should we sing?
We'll do it at dinner. We can do it at dinner tonight. We'll do it then. We're not having dinner. Again, that's a joke. You guys are making me feel...
We weren't invited.
Yeah, right.
Anyway.
I think you guys would have laughed quickly. Never mind. All right.
Do you get, like chocolate cake? What do you get for your birthday?
We're going to Rhode Island.
Rhode Island.
We got I knock off states that I've never been to.
Yeah,
My wife knows that, so we got a trip to Rhode Island. Yeah.
We'll have a lobster roll.
Yeah, that'll be good.
Yeah, they're tasty. Okay, well, with that, dear listener, we're going to call this a podcast. Take care now, and we'll talk to you next week.